Happy Friday, traders. Well, look, it's been another interesting week in markets. Probably the most meaningful and most interesting move in markets has been what has happened to US bond yields. Now, US bond yields did trade and came off quite a lot going into the FOMC last week when the Fed cut rates. But ever since the Fed has cut rates last week, we have seen bond yields just go one way, and that is back up. And not only have they gone up, but they have actually gone up in a meaningful move in that, the US 2 years, 10 years, and 30 years have all gone up about 20 basis points. So US 2 yields, which, were trading, sub 3.5% before the Fed, back up to now, 3.65. 10 years, which actually briefly went below the psychological 4%, back up to 4.2%. So yes, that is certainly a significant move. And it's something that obviously, when a Fed is cutting rates, having bond yields going back up the other direction is certainly something that is not friendly and market friendly. That is for sure. So what we've seen on the back of those US bond yields spiking back up is the US dollar is back on fire. So, the US dollar does follow bond yields. And one of the things that the market certainly was putting on quite aggressively was, short US dollar trades. And they've got that all wrong. So, we've got euro now that's actually broken 117 and it's going back down towards, 116 and a half. Dollar yen all the way back up to 150. And Aussie that was trading, as the highs for the year at 67 cents, is, going back down towards 65 and a half. So, we've seen some very big moves, in the currency space on the back of what's happening with these bond yields. Okay, so tonight what we do have, it's got some very important economic data coming out. It's US PCE data, monthly data. Now, this is the Fed's preferred inflation gauge. So certainly it's going to get a lot of market focus tonight. Now, year on year, last month, we had that come in at 2.9%. It's been going back up. And market does expect that to go marginally back up further to 3%. So the optics of that at 3% certainly does not look good. So one of the things that we're also seeing now is that, US equities, which, have been in a raging bull market, and we have seen, record highs after record highs. So we are starting to see some profit taking on the back of, what's happening with those bond yields, what's happening with the US dollar, and obviously what's happening, going into, important data, PCE. So I'd imagine, look, the risk tonight, if we get a number that comes out above expectations, I would imagine that certainly the market is not going to like that. And we're going to see some broad, across the board risk-off trading. So those bond yields are going to spike up more. Market may start to rethink about, how aggressive the Fed may be able to cut rates. And if they start taking some of those rate cuts off the table, those equities which love rate cuts and have traded a lot higher on the back of those rate cuts, obviously we could see, equities a lot lower tonight. Other than that, obviously the big market, a big market focus has been precious metals. Obviously what's been happening with gold and silver. Silver certainly has been outperforming, even traded as high as $45, above $45 overnight. But we are seeing it open Asia below that now. It did ignore what's been happening with the stronger US dollar. Not too sure whether or not it could actually continue, these gains if we did see big risk-off trading tonight in the market. So not sure if I'd be chasing silver up at these levels near $45. And gold as well. Obviously, it's found a bit of a brick wall up towards 3,800. and it is exceptionally volatile. Again, big risk tonight with PCE. Not sure if I would be, chasing it up at these levels. But anyway, just to recap, yes, tonight is US PCE data, very important data. And the big risk for markets is that we can see a continuation of bond yields higher, which would obviously initiate some risk off trading. So be very careful tonight. Good luck with your trades, and we will catch back in with you next week.